Welcome back to CNBC Africa's coverage of Nigeria's MPC announcement. As many had predicted, we did see a rate hike. Joining us to unpack the numbers, still with us, are Bismarck Rewane, the CEO of Financial Derivatives, and Esili Eigbe, Director at Escap Management. Gentlemen, thank you for staying with us. Esili, you called a hike, and you were leaning more to a hold. Let's start with you. What do you make of the decision, and of course the commentary around?
I think it was encouraging, and I think that there was a bit of a departure from the comments from the last MPC meeting. And what I mean by that was they were leaning more towards, I would say, something like a 1% increase in the subsequent MPC meeting. So it seems like what has changed between then and now is, for example, the federal government saying that they would import some goods, reduce tariffs on some, some inputs. Which I think is being optimistic, so just picking sort of the optimistic scenario, assuming that execution will be flawless, which usually
and
isn't.
Impactful.
So I think that we're going to have to see that, and that's what I'm emphasizing, that the MPC adopts a inflation targeting framework, because that holds them accountable. You can't just say, for example, that you're deciding to raise just 50 basis points because of some optimistic assumptions, and then you still continue to disappoint Nigerians further down the line. Let's know what your target is, and let's see how you gradually work towards that target.
Right. Bismarck, your reaction?
I'm a bit surprised that I thought it would hold, because I listened to his Business Day speech, which I thought was quite strategic in terms of this is what I want to do, and that he saw month-on-month inflation declining. But I think the trigger was that month-on-month inflation this time actually increased rather than decline, and then the rate of increase in inflation actually went up a little bit, but that was to be expected. I think this time is anticipating that let me move at least symbolically and sending a signal so that by the time the minimum wage kicks in, which is going to be inflationary whether we like it or not, by the time the spending on the fiscal stimulus plan goes in, weighing that against the effect of imported commodities, which may or may not have a direct impact on domestic prices. And more than anything else, I think the thing is targeted at foreign portfolio inflows, because he did mention that the FPIs and that the reserves are up to about $38 billion or something. So I think what the goal is to see whether hot money, foreign portfolio inflows will come in, and that will help stabilize the exchange rate. And that a stabilized exchange rate may translate into lower prices, especially because of the harvest season. But like I still said, delivering economic outcomes without institutional reform, and just because of policy announcements, it's not going to do it. There's so many things that are in play.
Right. But then we should also point out that the asymmetric corridor was adjusted.
Yeah, that was
so effectively the impact of the rate hike is actually more significant because it moved to 500 basis points.
Yes, but that is the bank's borrowing.
Right.
So the asymmetric corridor only affects the banks that go through the window, right? But if you look at what has happened to the treasury bill rates in the last month or so, they've been pretty stable, and as a matter of fact, declined a little bit. That was what gave us the impression or the indication that maybe there was a hold pattern. But I still think that there is still some element of a policy drift. There's no clear strategy as to this is monetary policy trying to mop up in anticipation of fiscal action, fiscal loose, lack of fiscal consolidation. So let me just do something, signal it, and I'll do it again, right? If need be, just to mop up liquidity, but that's not going to solve the problem.
Right. So Esili, let's now begin to think about the impact.
Yes.
Obviously, a big challenge for the authorities has been the stability of the exchange rate.
Yes.
What does this decision potentially mean for that? And then, of course, inflation. Yeah. What are your perspective? What's your perspective on it?
Just picking your last question, so your first question, I think that the rate increase wasn't significant enough to really drive, foreign capital into the country. I do speak to a number of internationals, and they've been particularly worried in recent weeks. And I think if you read the FT article, I think it was Thursday or Wednesday last week, that was, I mean, not revealing to me, but quite an expose for them. You know, it's always argued, you know, the idea that Nigeria was running this very large, you know, subsidy on fuel was kind of lost on the international community. So, you know, just realizing that this is still an issue was a big deal for them, and that really, you know, impacts investor confidence a lot. And you've seen the impact as well on even the trading of the Euro bonds too. And even appetite as well for, you know, even so last week, I don't know if you're aware, that was the almost, it was pretty much scrapped. They had to scrap the auction. And even yesterday, there was also a bond offer as well. Only the 10-year was subscribed, I think, about 200 times, 200%. Whereas, you know, the other two, I think the 3-year and the 5-year, didn't really see much activity at all. So I think that sort of speaks to both local, actually, and international confidence on the whole situation. And as far as it goes on the, you know, so I guess the possibility of drawing additional needed FX to help to, you know, continue to stabilize the FX market, I'm not that optimistic. You know, and with respect to inflation, that was your last question. Sure. I'm very careful to, you know, give a view on sort of where I see sort of inflation going. The situation is still very fluid. Like I said, the FX rate is still quite volatile. It can move either way, depending on how the central bank moves. This week, or even starting, I think, late last week, actually at the beginning of last week, they started putting some money to work. And they even committed to continue to do so this week. Maybe the rest of the month, we'll see. I think that's helped a little bit, but we have to see how that goes. But I'll say that the risks are more on the downside as far as inflation is concerned. What we don't realize actually is that for a lot of the big, you know, players in the market, you know, food as far as branded commodities, etc. So sugar, flour that goes into making things like bread, water. A lot of those guys depend a lot on imported inputs. So let's take bread, for example, wheat, which is imported, right?
So the exchange rate has a bearing on that.
Exactly. But even more importantly is that a company like Flour Mills hasn't fully incorporated the impact of the significant increase in wheat prices and also the exchange rate over the last year. They have like a roughly 18 to 24-month cycle where they pass the price increase over to the consumers. They don't do it in one go. So it's pretty normal for you to see, you know, this sort of 1 to 2% month-on-month increase on food prices because of the implications of that. I've just talked food, okay? Same implications as well for beverage producers too.
Sure. Your take on where the exchange rate is going, because I'm sure that's one of the things that people focus on after these meetings.
Let me try to do some analysis here. Let's take flour, right? This waiver on duty on flour, wheat, beans, rice, sugar, and a few others. So you have to take how much is the duty waiver relative to the price of the final commodity. So on flour we have 15%, 5% duty, and I think 15% levy. So it's 20%, right? So, but it doesn't just, flour is not the only, wheat is not the only component that goes into bread, other than sugar, baking powder, fortifier, and all of that. So generally speaking, we think that if the exchange rate remains stable, the price of a loaf of bread should actually come down by about almost 10 to 11%, or the price of a bag of flour will go from 59,000, 60,000 down by about 6,000 to about 54,000. But if the exchange rate moves, right, to a particular level, then all the duty waiver and things become meaningless because it's wiped out. The same thing happens with rice. The duty on rice is quite high, and then therefore you're seeing rice at about 85,000 now, and Christmas is coming. So I think that what is the biggest problem is that the demand for those who want to bring in these commodities before the Christmas, right, for Forex. So on one hand, you've removed the duty, but you've also, and there's an incentive for people to come and buy Forex to bring the goods in.
Which will drive demand for that.
Which will demand Forex, and then you see that the exchange rate moves in that direction.
So are you biased towards further weakness in the short term?
I think short term there'll be some weakness, in the exchange rate, right? Because 50 basis points is not going to make people change their minds about whether to buy foreign exchange or not. Because the gap between the dollar interest rates and naira interest rates has to be significant enough for me to say, okay, I give up that.
Right.
So seasonality for travel and hospitality, the harvest, local harvest will bring down domestic prices, but then this demand for imported foodstuff will also negate that. So that's, the exchange rate will not appreciate, but more than anything else, it might actually depreciate a little bit.
Further. Running out of time already, but I wanted you to quickly speak very briefly to how you see investment flows changing potentially after this. Do you think that we're going to see even a deceleration of flows, or do you think we'll probably get stuck in the range we're in now?
Deceleration, I would say more likely. I don't know for certain, but I'll say if I had to pick, it'll be a deceleration. I do speak to a number of those guys, and that's kind of the thinking. You know, if you even look at, you know, going into a lot of the banking offers, it's not, oh, I'm bringing in new money. I'll consolidate whatever I have already into perhaps one or two positions.
Let's leave it there. Thank you so much, gentlemen, for being with us. That's all we have time for on coverage of Nigeria's MPC meeting today. Big thank you to my guests, Bismarck Rewane, the CEO of Financial Derivatives, and Esili Eigbe, Director, Escap Management. Thank you for watching, and Closing Bell will be back later on.